Well, hi, everybody. Welcome to Buffett and Beyond Research and the Saturday Market Recap for December 14th, 2024. And yes, we're halfway through the month already. Well, this week, the Dow led the way down slightly this week as the S&P also fell, but the NASDAQ 100 stocks inched their way higher. Can't believe the bifurcation of this market. And the S&P may have put in a short-term top as its intermediate-term indicator turns to the downside, as we're going to see in a minute. In our weekly stock analysis video, AMD, Advanced Micro Devices, had been one of our favorite stocks, and it has great numbers. But what has us confused is why the market doesn't like this stock. Why? Because maybe everybody's looking at NVIDIA and not Advanced Micro Devices? Well, we'll take a look, folks. In our ETF video, the market was down this week, and we show which ETFs are performing and which aren't. And the transports, which look terrible, may be telling us we have some downside left in this market. And our two main portfolios made up of the best stocks, and several ETFs were actually up a bit, while the S&P and Dow lost ground this week. So we're just inching along here, folks, and the market's not doing much of anything, and waiting for the Fed this week to talk about interest rates and what they think the forward interest rate environment looks like. So, folks, let's get right into it. And let's look at the S&P 500 here. And could this be a little double top in here? Oh, my gosh. But the problem is that we're going down to the 6,000 level, which is right around the 20-day moving average, and we'll see what happens then. But what has us worried is this line down here. Blue line has crossed the red line, and that gives us an intermediate term sell signal, which we don't like. And also, we have the market going up here from here to here, and then down here we have this indicator making a lower high while the market up here made a higher high. That's not good. That's a downside divergence. And so we'll see why the S&P is in this state of mind this week when the Fed comes out and tells us about interest rates. Now, when we look at the Dow, well, the Dow has got broken down below its 20-day moving average, and we're looking at about 9 out of 10 days of downward movement. And of course, you see the intermediate term indicator down here turning down, and we're still overbought a little bit, so we have a ways to go maybe before this clears up a little bit. And maybe the market is thinking that the Fed won't be as dovish as everybody feels they should be thinking because of interest rates coming down. Maybe there's a surprise there, but inflation is being persistent, and persistent in this case means it's hard to bring that inflation down and bring that inflation that we had. Well, we're approaching 25, 26% over the past 3 or 4 years. So that's a lot of inflation, folks. Our buying power has been depleted by about 25%. That's not a good sign. And we could see it in some of the stocks that we're analyzing because we're getting ready to come out with our 2025 portfolios. And we see a lot of stocks that have just had a terrible year. And it looks like some people are going out and instead of going to the usual restaurants, they're going to Costco and they're going to Walmart. So are people eating in rather than going out to some of the restaurants? Because some of those restaurants do not look too good. Anyway, we'll come out with more information on that during this coming week. And when we look at the transportation, remember, if the transportation doesn't work, if we're not transporting goods, and that's what this transportation indicator is, or index is telling us, is that the transportations are not doing good. They're not bringing the raw materials to the manufacturers. Manufacturers are not transporting to the retailers. The retailers are not ordering because they're not delivering it to us because we're not buying. Yeah, we're all getting our food at Costco. You know, Costco is at, 55 times earnings? Have you ever seen Costco that high? Well, it's hard to see that the people are strapped for money and that inflation has really bitten into their spending power. So everything that you hear on TV where everything is goody, 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 we're looking at stocks and we're seeing a lot of movement of money toward the Walmarts and the Costcos and the BJs. So, folks, we have to be very, very careful in here. And this transportation indicator since last week has just dropped this bottom line down. It just keeps going down, and we can see that we are now getting into, well, mid territory in here with this at this zero line in here, but we're going, looks like we're dropping into negative territory in the sense that we're becoming oversold. So maybe Wednesday the Fed can cheer us up a little bit and turn this market around. And when we look at the QQQs, well, guess where the money's going? Or the stock money is going anyway. This is the NASDAQ 100, and we can see it just keeps inching higher. The Dow is going down. The transports are going down. The S&P 500 is going down, and the tech stocks are going up. So this is a good sign because we like these portfolios and we like these stocks. And you can see down here, this is the only place where we see the intermediate term indicator still positive, nicely positive too. So we'll see what happens, but our portfolios are doing very, very good because we are in the right stocks at the right time. Now, portfolio protection, this week we will be rolling over this December 20th put, and we'll be buying the March put. And the March will probably be around the 500 level, 12 to 15% below the present level of the market, so that we're hedged in case of some kind of disaster or some kind of really big sell-off. What's good about these puts is that as the market goes down, these puts gain in value. So it doesn't have to reach these levels like the 500 on the SPYs. It doesn't have to reach that level for this portfolio protection to increase in value. And that's why I always like this portfolio protection. Been using it, this type of portfolio protection, been using it for 40 some years now. And how do we get the money to pay for these puts? We sell a few covered calls, and in our professional letter, which we have, and not many people know about it, but in our professional letter, we said to go short the Dow over a week ago because we just saw that the Dow was breaking down. So we said, well, we might as well go short the Dow, and we used the double inverse ETF, and it's SDOW. So that makes it easy, short the Dow. So we're short 2 to 1. We just put 5% of our portfolio, which means we're protecting about 10% of the portfolio because it's an inverse 2 to 1 protection. So in our professional letter, we did go short the Dow, and that is giving us plenty of money to buy these put options as we go along. We don't sell many covered calls, but we do sell enough to buy the put protection, and also for the money managers that are following us to pay some of those management fees. So that's another good thing there. We also have portfolios where you can buy fractional shares, and we'll talk about that more later in the week as we go on and into the end of the year, which is just 2 weeks away. So our portfolios, well, the S&P 500 went down a little bit this week, and our growth portfolio went down just a tad, and our sector stars, which is a combination of the better ETFs out there over the past 5 years, and we take 2 or 3 stocks from each of those ETFs. That's sector stars, about 18 stocks, has gone up a little bit, and our top portfolio of the QQQs, and that's about a dozen stocks, has gone up just a couple of tenths of a percent. So we're doing very, very well. And look at these returns here, folks. Now, when you look at these returns, they don't match your portfolios because we have the exact same amount of money, or we started the year with the exact same amount of money in each stock. Now, you can't do that with most brokerage firms, but we have some brokerage firms where we can do that, and that's what we do. So we don't know which stocks are going to outperform the other stocks in our portfolios, and what we try to do is take the better than average stocks out of the hundreds of stocks in these portfolios. We take the better than average stocks and leave the below average stocks for somebody else to buy. Why pick an ETF because each ETF has better than average stocks and below average stocks, because most ETFs make up a sector of the market and they have to include all those stocks in that sector. So if you take an average, half the stocks are going to be above the average and half the stocks are going to be below average. And what we do is we take the above average stock using the clean surplus methodology, which we have been using for 20 some years now, from the doctoral dissertation and also from a book called Buffett and Beyond, second edition, published by Wiley. You ought to read that. It makes all the sense in the world, and you can get these returns too. So folks, don't forget, we know some money managers who follow our portfolios exactly as we write about them. And if you want those, just let us know. But right now, we're doing very, very well, folks. We're almost doubling the S&P 500 right here with our top portfolio. So, folks, we had a almost do nothing type of week this week because we're getting ready to hear what the Fed has to say on Wednesday about interest rates. And not only will they raise or lower interest rates, and we think they're going to lower interest rates just like everybody else does by about a quarter of a point, but it's what they say about the future of inflation and whether they will be cautious or not in lowering interest rates further so they don't spark a rebirth of inflation, because some of the PPI numbers, producer price index numbers, didn't look too well this past week. The CPI, consumer price index, looked good, right on target, but the producer price index, which is the cost of manufacturing the goods that we buy, didn't look too good this past week. So that gives the market a little bit of pause to say, all right, let's take some of the money off the table. And that's why the market has been drifting a little bit lower here. And of course, people are selling some of their stocks because of long-term capital gains, short-term capital gains, and that whole tax situation out there. And so you see a lot of jockeying around, and that's exactly what's happening. So folks, go out this week and shake it off, go for a walk, be with your family, have Sunday dinner together, and folks, you stay safe, be well, and we'll see you right back here in a few days.